Welcome to the daily update, where I'll go over the action in the market for Wednesday, June 11th, and we'll see how things look for Thursday, June 12th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. Okay, well, we had CPI come out, probably the most important report of the month after the employment report, and the headline number looked pretty good, but the annual rate ticked up, and so that caused some concern in the market. We're still looking more positive. This is just appearing to be a pullback now. Of course, you have a lot of folks that buy the dip. They tried that, but then prices ended up going down lower as the day progressed. But we're still not trending. We're trying. And I'll show you the ADX charts here in just a moment. But we're not quite there yet with a trend, even though we're still leaning more positive in spite of the down day. There's some warning signs that we want to be aware of that I'll go through here. So right at the open, we did have a higher open. There was positive reaction to CPI, some gyration that occurred after the report came out, not so much at the open. We were able to climb up to R1 at 6,054, so now we're dealing more with the mid 6,000 range. Then we pulled back from there to the unchanged level. We dropped negative. We did find some support lower, but before that, the daily pivot was breached, at least initially, at 6,027. Prices did try to rebound, though, and then they declined back down below the unchanged level in the daily pivot again, but found support at S1. That's why I update these pivot points on the YouTube community tab. The market just keys off of those, and they're very important levels to watch. And this S1 was at 6,012, so we're still above the 6,000 level. And then we closed slightly below the daily pivot, a little bit of a bounce up off of S1. We were down 0.27%, and we continue to be below average with volume. We are still positive in the short, intermediate, and long term because we're above the 20, 50, and 200 period moving averages. The news coming out about the trade talks, underwhelming, and we've seen more of this positive bias, some trying to front run any kind of an announcement, just assuming that it's going to be positive. Well, when the news came out, it's like, okay, we're not really hearing anything new here, so let's sell instead of buy more. And that's kind of how that unfolded as well. So some comments. CPI was weaker than expected. When you look at the headline numbers, it was very underwhelming as far as the update from the U.S.-China trade talks. It didn't result in anything new or groundbreaking, but at least the two sides agreed to implement what was already agreed upon during the mid-May meeting in Switzerland, and those are known things. And Commerce Secretary Lutnick did say that 55% tariff rates on imports from China will not change. And then the U.S. Court of Appeals did come out and said, okay, the president does have the authority to enact these tariffs. So the U.S. Court of Appeals upheld President Trump's tariffs ahead of a full hearing that will be held this summer. So there's still more to come with this, but they're kind of allowing this to happen for right now. The U.S. and India might announce some kind of an interim trade deal by the end of the month, but there was really no reaction to that. Then the trade deal between the U.S. and the EU could be made after the July 9th deadline. Of course, you set up this deadline, we've got to have an agreement by then. Okay, well, it's kind of like the debt ceiling. We're not going to go above the debt ceiling, but we need to raise it now. Here's a deadline right here, but they may go beyond that for an actual agreement to be worked out. Then the U.S. is also nearing a deal with Mexico to reduce steel tariffs and cap imports as well. I mean, so there's stuff happening here, but nothing that is emotionally charged like it was in going from March into April. Then the U.S. and Canada have begun exchanging terms on a deal pertaining to trade and security. ambiguous there, nothing real substantial. And then switching back over to the market, we are seeing the semiconductors leading, and that's encouraging and that's positive for the market. If semis can lead tech and then tech can lead the market, that's when the market is quite positive at that point. And then energy is bouncing now, and that's been getting hammered in 2025, but we are seeing some kind of a bounce, at least recently, that is helping that overall sector. The VIX is still below 20. We did climb back up. We're in the 17.26 range now. And then here's our short-term list. We're still seeing positive short-term momentum, and they're starting to get extreme with the StochRSI, the Williams Percent R, CCI 1420 stochastics, and we're still far away from the 20-period moving average. But these first four, the StochRSI, Williams Percent R, the CCI charts, and stochastics, those are usually extreme positive when the overall market is positive. So even though they're extreme, it's showing we're seeing confirmation of upward bias, and that has still remained. It's getting far away from the 20-period moving average. That's a bit of a concern. In the intermediate term, we still have our momentum oscillators like the PMO and some of the oscillators that are actually drifting lower, but they're still in extreme positive territory. And it's really hard to see here. The bullish percent index for the S&P, it's chopping around right now, not really showing any strength, not really showing any weakness. It had turned a bit negative, but now it improved just a little bit there. But the Nasdaq 100 bullish percent index is also extreme, and we're also far away from the 50-period moving average as measured by the boom indicator. No changes with the Fed scenario. I haven't had to update this now for quite some time. The dollar was down, interest rates were down, and that's encouraging because we're under that 4.5% level with the 10-year yield. We're down to 4.41%. So that could be giving some support to stocks. If we were to climb back above that, that is often when it starts to pressure stocks. Sentiment is still positive. We did tick down a notch to 62 where we had been at 63, and we're still not trending. And I'll have charts to back up all the stuff I'm talking about here. We're below the moving average with the ADX. It's trying to kind of cross a little bit there, but it's not really blatant at this point. And we're below 20. And with the down day, the bias is negative. I'm still keeping the momentum at mixed. You could possibly lean a little bit more positive, but I just for right now, because we're not trending, that also shows a lack of conviction that's happening in the market, so I'm keeping it at mixed. All right, we did get total CPI, the headline number that comes out. It was up 0.1% month over month. That's less than the 0.2% they had expected, and last time it was up 0.2%. Then the core CPI, this is the inflation component. You take out food and energy, of course, the things you have to have. It's like, let's not count those as far as inflation, even though you have to have food, you have to have energy. It's like, well, they don't matter according to this. It was up 0.1%. They expected it to be up 0.3%. And this was the initial positive reaction that we saw, where last time it was up 0.2%. On a year-over-year basis, it's ticking up now to 2.4%. Now they round these numbers up. The numbers that I show here is just one decimal place, but they go out many decimal places. And that's why you've got, depending on how they're rounded up or rounded down. So on a year-over-year basis, we're at 2.4%, where we had been at 2.3%. And remember, the Fed is trying to get down to that 2% level. Then the core CPI, it's the same now at 2.8%, but it didn't decline. And the market was like, okay, it didn't go down. We're treating this as more negative than positive. The Treasury budget, still spending more than they're bringing in, but it's a little bit less. It's a minus 316 billion. Last time we had the report, it was a minus 347 billion. Not when we had the report, but it was a year ago, because it's really hard to do a month-over-month comparison with this. All right, so on a year-over-year basis, the budget is up 13.6%. Last time we had an annual year-over-year calculation, it was at 22%. Okay, interesting. All right, so we get this every week, the MBA mortgage applications. With interest rates coming down recently, we saw a bit of an upsurge here in the new mortgage applications reading. Okay, and here is the year-over-year CPI, which is starting to level out after it had been declining. We have the blue line, that's the total reading, and then the core is also starting to flatten out. That's the inflation component. Then when you look at services and commodities, we're seeing commodities coming up, and that's why we watch the CRB index. That's why I do the intermarket analysis video over the weekend, just to kind of keep track of what's happening there, where the services are actually coming down on a year-over-year basis. Then here's the federal budget. Just it's always negative. See, the zero line is at the top, and then we just get more and more negative down here. This is why we have a bond market. This is why a lot of folks are having problems with the reconciliation bill. This is why the government is always in debt. Now, some of that is by design that goes way back hundreds of years. But when you tack on all of the entitlements and things that aren't even included in the massive debt that the US government is carrying, it's like, okay, this is a problem and something needs to be done about that. So what do? We're going to add 4 trillion to the debt. Yeah. All right, here's the chart that I look at. First of all, we look at year over year. That's the rate of change every 12 months here, where it does appear to be flattening out. But because of the decimal points, it doesn't, it's not as, it doesn't move as much with this calculation, where we're actually declining when we look at month over month changes here. Then here's the important one, the core CPI, taking out the things you need, where we're flat pretty much here on a year-over-year basis, but declining on a month-over-month basis. Then, looking at the Treasury budget here for federal receipts, that's what the government took in, and then outlays. So receipts, that's the blue line, and you see how much they're spending. That's the yellow line, even though it's coming down slightly. Do you see a little space between the two here? Yeah, that means the government is going more and more into debt. All right, so here. This is a chart that every once in a while pops up. It says, of course, you have to be a super genius to even make this come into reality. But it says growth of 10,000, strong versus weak periods. Unfortunately, we only know if it's strong or weak after it's already happened. But yeah, if you were to get in during the weaker times, you're down in this blue area here. Their money still would have grown, but a lot less. Where if you got into the stronger time, the orange area, you'd do a lot better. And basically, they've tried to break these down. This is why I go through seasonality, not only on a day-by-day basis, but we try to take a bigger picture look as well. The November to April period, that's considered to be better, okay? And then the May through October, sell in May and go away, which that's pretty much been disproven, but it's still a cliche that is used. Those are the periods of time that are considered to be weakest. Not necessarily the whole period itself, like September is usually the worst month of the year. And then we've had really good Octobers, but we've had really bad Octobers too. That's why my approach is just to take a day in and day out analysis of what's going on and then just generate the overall picture of what's happening and then say, okay, we're looking more positive, we're looking more negative. And then tomorrow we'll do the same thing. All right, so year 3 of bull markets can be choppy. Well, tell that to everybody because we all have seen that. The red line is what we're seeing here, where this is the dip that we saw from late March going into April, and then so far the bounce up out of that. And, you know, I mean, all of these look like an advancing EKG here, but that's the way the markets work. They're usually rather choppy. Okay, then market implied U.S. recession probability by indicator. It breaks them all down and then takes an average, and 17%, where most of it is the forward implied change in the Fed funds rate. That's still coming in the highest right now. And then those down at the bottom think, okay, this tries to measure if we're in a recession right now. Because I don't watch those videos, but I see a few of the headlines where, you know, they say these scary headlines just to get more views, even though they end up talking about something completely different in the videos. There are a group of people out there that think that we're already in a recession, but that's about 3% according to the different indicators that we look at here. All right, then, of course, since we've been going back up, people have to revise their forecasts. It's like, I thought a forecast was supposed to be good for a whole year, but no, that's not how they do it. But this is from Yahoo Finance. Wall Street forecasts haven't fully recovered from tariff turmoil. Okay, we're going down and they're revising everything down. Now we've been going back up, but they're not quite back up to the higher numbers that they were at before. Then we get this chart periodically too from Isabel Net. There's a systematic approach that some people use with investing. It's like, I don't really care what the market's doing. I'm just going to add my $100 a week or $1,000 a month or whatever you put into some kind of a program, and you follow a system regardless of if the market's going up or down. That's a system. And that tends to hold up quite well when we're really going up, when we're in a solid bull market. Where the other approach is more discretionary. It's like, okay, things are getting bad. I think I'll pull out of the market and maybe go to cash right now. That tends to do better when we're going down, but it tends to underperform when we're going up. And even the systematic approach, it took a hit when we were going down in April. It's been recovering, but there's still a disconnect between the two. The discretionary type of approach, where you are a little more hands-on with your investing, that's still outperforming for right now. Now, if we can get into a sustained uptrend and keep going, we'll probably see the dark blue line cross above the green line at some point. And then these are just different events that have happened, causing the market to go either up or down. Okay, now this is kind of interesting, which is something I have not experienced this personally. Any traveling I've done over the last few years, this line should be going up. But airline traffic is negative year over year, always a bad sign for growth. And of course, TSA, all right, take that for what you want. But I see on every plane I've been in over the last few years, it's been packed. Very few times do you see many open seats at all. But when you measure it this way, it's actually been declining. Could be, wheels falling off and doors blowing out, and that might have a little bit to do with it. Then small cap equity positioning. The small caps are still, now they took a hit in Wednesday's session, so we have a couple of up days and then it tends to fall back, but we're seeing a little bit more money coming into the small caps now. And sector flows kind of sideways right now, but most people are still putting money into tech, and that's a growth area. And when that really gets moving to the upside, that's where you see some really good gains there. But it's usually week after week the leader. That's why we see the yellow line at the top. Then here's some different things for charts from different sources that I use. CPI, perhaps the biggest argument against current CPI signaling further disinflation, which means that prices are actually going down, is the diffusion index. It's right around 50. This is not an inflationary figure, but it's not deflationary either. If you look over here on the left, 50%, right now we're right around 50. And I go through this too, but I mainly focus on the CRB index, looking at commodities. And I do a ratio, but it's a long-term ratio. It's a monthly chart between inflationary areas and deflationary areas. And we've been drifting lower. There's also a moving average that we follow on that chart. But this is just showing that there's an equilibrium right now, according to this anyway. You might look at a different chart and come to a different conclusion, that we're kind of at the balance between inflation and deflation. Okay, then reserve assets. They're becoming more and more of gold here. And this is put out by the Financial Times, where at the bottom, okay, that the dark blue, this is central banks that have the euro. And then the light blue, these are central banks that have US dollars. And then other, I always like the other, okay? And then at the very top here is red. And so gold is now what most central banks are having. And that's been helping the price of gold to go up. Because if you have these big boys coming in their countries buying gold, that tends to push prices higher. Then investment manager index, risk appetite. People are feeling like, okay, we're willing to assume a little bit more risk now after we were freaking out earlier in the year. But they also expect the market to be pulling back a little bit, according to this survey. And then retail flows says U.S. captured a significant 250 billion share in the global 400 billion retail flow. These are people like you and me that have brokerage accounts, and we go in and we buy stocks through a broker, we sell stocks through a broker. However, in the recent month, retail flows favored Europe over the US. And I show that in some of the charts. And I went over it in last weekend's videos. I look at those charts every day. I don't have any of those to show you right here, but Europe has been outperforming the US. And emerging markets, which sometimes people like to get into, they're underperforming developed markets. But the biggest developed market is the US, and that's been underperforming Europe. And that's still remaining a little bit more strong. So, which coincided with retail inflows into European equities. And this, again, be careful of something like this because about the time everybody catches on to this, we were seeing this months ago, but when it becomes more common knowledge, that's just about the time it's going to finish and be over. But I keep watching those charts, keep watching these videos, and if anything substantial happens, I go over that. Semiconductors, this is encouraging. We're seeing semiconductors coming back and taking a leadership role, and that is very helpful. This is really what brought us out of the October 2022 lows. We first started to see semiconductors show some improvement. That helped the tech sector, and boom, from that, we started to go up from there. So this is encouraging, and I do have a chart to show you later of that. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Okay, so here's the intraday chart. Higher open, but immediately saw some selling into some strength. But then we were able to get up slightly above R1, came back down below the unchanged level, just about got down to the daily pivot. This is where the buy the dippers come in. They tried to take us back up, but it really didn't go very far. We got back up to the 60-50 level. Then later in the day, this is when I really start to follow the market, is usually about lunchtime on the East Coast. Now we saw some selling. This is the smart money doing some things here. Took us down below the unchanged level, so we went negative below the daily pivot. We did find some support at S1. That's why I update these charts on the YouTube community tab. And if you're in my program, I also update that in a couple of different places. But these are levels that we know about before the market even opens. And we came down here, we were able to set some support up here at S1, but we saw a little bit of a bounce here. We still closed below the daily pivot, but this just shows right now anyway that support held. All right, intraday, we're down a little bit more in the initial overnight session. There's a little bit more fallout coming on. We might be getting ready for some kind of a rough patch. That's just pure speculation on my part. But CPI, the market could have just shot to the moon, and we could have went and given the previous all-time high a real test at that point. But the market didn't do that. And so now, like last week, any kind of news that came out was twisted as positive. Are we going to start to shift over into a phase where any kind of news comes out is going to be twisted negative? You know, that the market goes back and forth. It ebbs and flows through that kind of a cycle. We are seeing a little bit of a concern here where the blue line had been comfortably above the red line. The blue line is large cap growth. The red line is large cap value. Now they're starting to meet up with each other a little bit here. Now, if we see the blue line drop below the red line, that's going to turn things a little bit more defensive on an intraday basis. We're still doing okay with our intraday S&P growth to value chart, but we've been just chopping along sideways here. But we're not really declining with any real conviction. And we look at this in the bigger context. We go back to April and see how the growth to value ratio has been really improving. But now we're just kind of chopping along sideways, kind of like our trend. All right, so everything was down. Growth was down less, though, than value. It was down more for the mid caps, but less for the small caps. So we're still looking okay in the bigger picture. These are our end of day charts. Small cap growth to value, still hanging in there in an uptrend. Mid cap growth to value, still in an uptrend here. And we are now generating a golden cross with S&P growth to value. Because we spent so long above these moving averages, the 50 period is now starting to cross back above the 200 period with this ratio. So that's turning things more positive. We're still holding on, looking okay here when we do this growth to value ratio. And discretionary to staples, still hanging out above the 200-day moving average. So not that we're seeing a lot of weakness, and we're seeing basically a little bit of strength that the market for right now has been able to hold on to. This suggests that maybe we're seeing a pullback rather than an actual reversal. Okay, here's the trend. Trying to turn up a little bit here, but no real conviction with the short-term ADX. We're still positive with the green line above the red line, and we're still chopping along sideways with the intermediate term. This is the one that I focus on the most, but we're positive with the green line above the red line, but we're still below 20. That means we're not trending, and we're not moving above the moving average with any real conviction here. So it's not really a weakening trend right now, but it's certainly not a strengthening trend either. And then value continues to be below, excuse me, volume is still below average. We're still seeing lots of red bars here with volume. Sentiment still under 20 with the VIX. So we ticked up a little bit here on a closing basis, but as long as we're under 20, that's more positive. All right, and the VIX of the VIX spiked up a little bit here, but we're still below these moving averages with the volatility of the VIX. We declined with this fear gate. We're virtually unchanged, but we have been declining here where we were up with this other fear gauge. So a little bit of a contradiction there. We declined with the daily equity put call ratio chart. There might have been some hedging going on ahead of CPI that then was taken off in Wednesday's session. So we're just kind of chopping around in this red line area. This is the extreme reading here. We're kind of just not really showing an awful lot of conviction on our 5-day chart, but we're still continuing to decline with the 10-day chart. And typically when this is declining, that is more positive. And even though we fell back with the risk on to risk off ratio, overall we have been going up, and that's more positive for the market. And we were up just a little bit here with our high beta versus low beta. When this is going up, that's more positive for the market. And we did shoot up a little bit to the top end of the range with the volatility risk premium. We'll see if we end up breaking out of the range. That could anticipate some fear coming back into the market. All right, advanced decline lines ticked down a little bit, but still looking positive overall. We went up a little bit here with our 10-day advanced decline oscillator, and we're above zero, so that's still looking positive. We declined, but we're still above zero with our short and intermediate term advanced decline ratio. We're seeing the new highs starting to come down here, so that's causing our 5-day to roll over, but we're still above the moving average. The 10-day moving average is seeing a bit of a decline, so that's showing a little bit of internal weakness coming in. Now, looking at the accumulation distribution, we're still above the advancing moving average, where we've just been chopping along this red line with the boom indicator, which attempts to measure what's happening between the indicator and the moving average. It's not a true measurement, but we were a little bit above this line going up after Tuesday. Now we're a little bit below it after Wednesday. Now we're negative here with the Chaikin money flow. We're coming down with the histogram. The red line is starting to come down, so that's negative. And we were improving with the Chaikin oscillator, but we never crossed back above the moving average. Now we're starting to turn back down, and we're further below the moving average. Now, this is interesting. The vortex probably picked up some of the early strength in the day, so we actually are going up with the green line and down with the red line. So this is positive. And I've been trying to show some more advanced decline studies here. This is the cumulative advanced decline line for the S&P based on price. Not really much of a change, an awful lot of sideways chop. What's more positive is we actually broke out to a new all-time high here with the cumulative advanced decline line based on volume for the S&P, even though it did tick down in Wednesday's session. But this is still looking pretty healthy. And then we're still looking pretty good, more intermediate to somewhat long-term with the 10-day average of the highs and lows for the S&P. We came down, but we're still above this green line. That's showing more internal strength longer term. And we're still above all the moving averages with the advanced decline line studies that we look at for across all the different indexes. And we are breaking out again, setting another high here with the cumulative advanced decline line for the NYSE. And then we look at a regular NYSE advanced decline line. This is still holding up quite well. We're also holding up well with this other NYSE advanced decline line, which is calculated in a slightly different way. Then we break it out based on stock, tick down a little bit, but still looking good with the common stock based on price and setting a new high here based on volume. Okay, this part actually went up. And so that's showing some more broad market strength. And chopping around a lot here above 50 with those stocks in the S&P above their 20 period moving averages. Still looking pretty solid with the 50 period, 100 period, and 200 period moving average studies. Still above zero and going up with our 5-day moving average of the highs and lows across the broad market. And here's the chart now. I was trying to point this out here, and this ended up coming into play. You see this dashed line here? This is a previous month's pivot point. Well, we're kind of still dealing with that right now. These are June's pivot points, and then you have July's pivot points already calculated. That's why I like these pivot points. They're on this chart way ahead of time. Well, we came right up to this dashed line, and that was the high that was set. That's kind of why we topped out and stopped about where we did. And then we started coming down from that level, and we're continuing to be below average with volume. So declining, but still above 50 with the 20, 50, and even 200 period moving average study for the S&P. And we came down here with the StochRSI, but we're still extreme. So we're hanging on to that being positive. Also declined, but still extreme with the Williams percent R, the CCI 14, and the CCI 20. So even though all these pulled back, when we see high readings like this, that just shows more positive momentum in the short term. And we're coming down here, but we're still extreme with the short, intermediate, and longer term stochastics, which is a further subdivision of the short term time frame, or all three of these charts. And declined below the midpoint with the force index, still going up with the green line and the blue line with the short-term trend study here. And we've come back down into the +2 channel after being up in the +3 channel with our standard deviations chart. When we get up into the +3, that's when this is starting to look extreme. Intermediate term did see a little bit of a bounce here with the balance of power, and we're still above zero. We're still looking okay here with the bow tie. We're above the green fluorescent moving average here. That's a 10 period simple moving average. And the line is going up and price is above the line. So that's still holding together right now. We're positive with the go, no go with the darker blue bars. We're still hanging out around the blue line, which is the highest high value. So that's hanging on to being positive. The Landry light and the proper order are both showing longer term uptrends. But the TTM squeeze continues to, well, possibly bottoming out here a little bit. But if we see more weakness, this is going to continue to go down. So the darker blue and the fact that this is declining is actually making this chart negative. And we've been hovering right around the zero level, even though we turned up slightly with the ease of movement with a down day. That's kind of encouraging. We're not really getting a lot of conviction with this indicator. We're still looking okay. We're above zero and not quite at an extreme reading here with the Arun, meaning buyers are still in control. Now, the S&P McClellan oscillator, which has been very choppy, we actually dropped a little bit below zero. So even though you can't see it here, the summation index, when the McClellan oscillator is below zero, the summation index declines. But we're just kind of leveling out here, but we're still going up based on volume. And we declined, but we're still above zero with the NYSE McClellan oscillator. So we're still going up with the summation index based on price as well as volume. And we're rolling over a little bit. We're getting a mixed picture here with the Swindler trading oscillator. We're still going up based on volume, even though it's slowing down a little bit. We're flat and now starting to go down here based on price. And here's our momentum oscillator, just kind of hanging out where it's been for quite a while, still above its moving average. But when we break it out based on price and volume, we are improving. And based on volume, we're starting to cross back above the moving average. That's encouraging. And we declined slightly below 50 with the PMOs that are rising. We're slightly above 50, but declining with the buy signals. And we're still going up with the PMOs that are above zero. We've gone from positive to neutral with the Elder's Impulse system for the S&P. We're still positive with the parabolic SAR since the dots are underneath. We're turning up, but still below the moving average with the slope oscillator. This is a short-term oscillator. We're still having a tendency to decline overall with the MACD. So this is the top one. This is the slope oscillator that's improving, but still negative. We're going up ever so slightly with the TSI, which is our other short-term oscillator. We're flat with the MACD, still sideways but above the moving average with the PMO, slightly declining with the PPO. Longer term, the TRIX starting to decline, and the KST is also starting to decline. That's longer term. So we want to be aware of that. But see, they're above here. It's the TRIX is above the blue line, and as is the KST. These are extreme positive readings. So that's why we want to keep an eye on this to see if we're not going to develop into some more of a meaningful decline. We're improving, but still negative with the Copic curve. Still up in the green area with the Sean trend meter, above 50 and advancing with the money flow, above 50 but declining with the ultimate oscillator. Still above an advancing moving average with on-balance volume. And we were extreme with the short-term RSI. Now we fell back just a little bit here, but both the short and intermediate term are above 50. That's why they have this green area here. That just shows stronger momentum. When the majority of the time we've spent at above the midpoint or 50, that is more positive. The intermediate term trend still hanging in there. Another day, and we're going up here with the red line and the blue line. This really has been looking pretty solid. We're still above all the plotted moving averages. We're still far away from the 20 period and 50 period moving averages. And this is kind of this jumbled little mess here with the bullish percent index. We're still extreme positive, but and again, I don't like to look at charts this way. If I need a magnifying glass to determine what's going on, that's not good enough. I want to be able to look at the full chart and have it blatantly tell me what's going on. So it's really hard to determine if this is more positive or negative right now. And we're still looking positive, though, with the NYSE bullish percent index, but we declined a little bit, but we're above this blue line, which is extreme, with the NASDAQ 100 bullish percent index. We're still working off of a Pring by bottom Fisher buy signal. And it's not really going up here. But again, I wouldn't necessarily base everything on this. This can give very good signals. It can give very bad signals. All right, and we're still looking okay here. And if you look longer term, this is a weekly chart. We not only are we seeing a series of higher highs and higher lows on the daily side, we're seeing that on the weekly side as well. And we're still looking okay. We're positive with the Heiken Ashi. We're positive with the Kagi chart, positive with the Renko chart, and positive with the three-line break. So all the different confirmations of trend are still positive. But our ADX is still showing that we're not trending. And we did have enough of an up move right at the open to get us up to that 6,050 level. That drew in a new X. We're working on an ascending triple top breakout, which was generated last week. So this is still holding together for right now. In longer term, we declined, but we're still above the midpoint here with the 150 and 200 period moving average studies. So this is a broken record here. Still negative in the long term with the mid caps and small caps. Everything else is positive. And commodities are now looking a little stronger in the intermediate term. Bonds have switched back to positive in the short term. The dollar is still negative on all time frames. And we see energy. It had a good day. It was up. Oil's going up too. I'll show you that chart later. Utilities, another defensive area. Healthcare, see the more defensive areas are the ones that were up. Where we see materials getting some profit taking there. Discretionary, that's a pseudo growth area. Communication and tech, those are the big growth areas. They were actually down. And so we had Canada setting another new all-time high. The NASDAQ first fell below 19.7, then it went above 19.8, then down below 19.6. Yeah, kind of a choppy day. And then oil got above 65. That's where we're seeing that going up. That could be inflationary. Here's our market carpet, and you see the big squares here. These are the bigger companies. NVIDIA was down, Apple was down, and then Amazon was down. Tesla was up minuscule. And then we had Google, Meta being down. This is why the market ended up going lower in the day, but not huge moves when we look at them. We are still seeing a bit of a disconnect between the weighted version of the S&P and the equal weighted version of the S&P. It still looks like the bigger stocks, the mega caps, are coming in and assuming some leadership. And if we see that coupled with semiconductors coming back in and actually leading tech, that could be positive for the market. But we're just kind of watching that unfold right now. And then we're still going up for the most part. It was virtually unchanged, but up just a little bit here when we do a ratio between the weighted versus equal weighted version. When this is going up, that means the weighted version of the S&P is outperforming. And when that happens, that means the bigger stocks are doing better and taking more of a leadership role. We're still above the 200-day moving average with the Dow. It ended up finishing unchanged, but we're positive with the diamonds, with the Elder's Impulse system, and we're getting really close to this R1 resistance level here for the NASDAQ. We're not quite there yet, but we're getting close to this, and now we've been seeing a bit of a pullback with the NASDAQ down 0.5%. We've gone from positive to neutral with the Elder's Impulse system for the NASDAQ, also getting kind of close to this R1 overhead resistance level here with the NASDAQ 100. Also positive to neutral with the Elder's Impulse system, but the momentum for the NASDAQ 100 continues to drift lower. And then see how with the small caps, we got a little bit above this R1 level. We came right back down, closed on it. Now, after having a good couple of days, we'll see what happens here. And we're starting to come down, and we've actually given an overbought signal now with the Russell 2000 small cap index. When we look at the RSI, dealing with the 200-day moving average, which could be acting as overhead resistance here, but we are still positive with momentum as measured by the MACD. Going from positive to neutral with the small caps with the Elder's Impulse system, still the 200-day moving average for the mid caps is acting as overhead resistance, also switching to neutral after being positive with the Elder's Impulse system. And here's the Wilshire. It was down, but this is also looking pretty good. Series of higher highs, higher lows above its 200-day moving average. Seeing kind of that same thing here with the total U.S. stock ETF, even though it was down. It's still not a terrible looking chart pattern here. The financial sector was down slightly. The uptrend is still intact there. But what we've been watching is a little bit of a concern where we look at the financial sector on a ratio basis with the S&P. This had been outperforming. You go back to last summer, August 2024, this was helping the market to really go up. And lately, we've been seeing this ratio starting to drop off. We're just watching this right now, not really making any decisions from this, but it's a little bit of a concern here. All right, then the FANG index. This is one of the stronger areas of the market. It was actually up 0.09%. These are the really big stocks generating a recent golden cross, a nice looking chart pattern here, and holding up quite well that way. But Apple was down 1.92%, Amazon down over 2%, Microsoft just generated a golden cross, up 0.36%. Google, in a downtrend, was down 0.7%. Meta, trying to generate a golden cross here, but it was down over 1%. NVIDIA, down 0.78%, also in a downtrend, but above both of the moving averages. Tesla, which is pretty much gained back what it lost a week ago now with the Musk-Trump feud, which I don't know. I haven't been paying all that much of attention to it, but because of what's going on in LA, it seems like that's kind of drifted out of the pop news cycle lately. But it's probably there somewhere. I just don't pay attention. And then a little bit of a bounce back up here with Netflix, probably still the best looking of the big stocks that we look at here. We're still tending to go down with the staples to tech ratio. That's positive. We're still going up with the semi to tech ratio. This is the one I wanted to show you. Now, it was down a little bit here, but if this can continue to go up, similar to what we saw at the beginning of 2024, that could end up being quite positive for the market. We're still in downtrends when we look at the semiconductors, but we're seeing some improvement on a relative basis. And still pretty strong correlation in the short term between U.S. and world stocks, a generally strengthening correlation when we look at the longer term correlation. Oil getting up into the high 60s now. That could be inflationary. You're probably going to feel that at the pump. Dollar still in a downtrend, dropping back below the 99 level. And now Truflation, which is an independent company, see, we came out with 2.3%. That's what the government report was. They're coming in at 1.94%. We're still below the 4.5 level, though, with the 10-year yield. And as long as we stay under here, that could help support stocks. And we're coming back and slightly crossing back above the 50-day moving average with the 10-year based on price. Still holding up okay here with our growth to value ratios when we look at the Qs to S&P. Large cap growth to large cap value. Where we're seeing some weakness is when we look at discretionary to the S&P. But doing okay here, not great, but the large caps, mid caps, and small caps, even though we're declining with the small caps, we haven't broken below the moving average. So the moving average continues to go up. And we're still tending to go up here with the S&P to utilities ratio. When this is going up, that's more positive. And when this is going down, that means staples are underperforming the S&P, and that is positive for the S&P. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. So what's the outlook then for Thursday? No change here. We're positive in the short, intermediate, and long term, but we're not trending. And we're going to get initial jobless claims, PPI. Also, both of these are quite important reports. And then anything geopolitical, whether it happens in the U.S. with all the riots going on or something geopolitical and outside of the U.S. like Russia, Ukraine, Israel, just keep an eye open for those things as well. All right, then we're going to get consumer sentiment on Friday, which I'm have that in gold right now because it's everything is so emotionally charged right now. If folks are feeling better about things, that will help the market. If they're feeling worse, that might hurt the market. All right, here's what we're looking at for Thursday's session. Seasonality, we are positive for June 12th. Going back to 2002 with the Dow and S&P, we're neutral to positive with the NASDAQ. And now, after seeing a few days here during a post-election year, I'm following the green dashed line. That's the S&P for a post-election time. We do see a little bit of a bounce here for the next day or so, but then we see some more weakness as we start to head into the second half of June. And this is more of lackluster here as measured by the Stock Traders Almanac, where you'd think that we're already in the dog days of summer already. And then this, I'll probably stop showing this here pretty soon because this chart's kind of fuzzy. And usually I show these a few days in the daily video and then I switch them over to the weekly video. But nothing really that big when we go back to 1950 for the S&P. For June, we're up a little bit more than half the time with not a very big return of 0.2%. Also, if you just measure post-election years, we're up 7 out of 18, down 11 out of 18 with a negative return for post-election years. Here are the pivot points that I've been talking about, which have already been updated on the YouTube community tab. All right, so we're still keeping the smart money indicators on the negative side for right now. Coming down a little bit with the boom indicator with accumulation distribution. We're negative with the Chaikin money flow and the Chaikin oscillator. The discretionary to staples ratio, and that's by measuring it with a trend. We're still in a downtrend with that. The S&P, not the NYSE, but just the S&P McClellan oscillator and summation index. The McClellan oscillator dropped below zero, so that's slightly turning the summation index down. The Copic curve is negative. The long-term special K chart, which I show over the weekend in the deep dive video, and the momentum for the NASDAQ 100 is drifting down. Then on the positive side, this is actually a new addition here, the long-term growth to value ratio. We've just seen a golden cross with that. The S&P is still considered negative with the bullish percent index since it's right around its moving average, but it's still extreme positive. The NASDAQ 100 and NYSE. So these are positive. In fact, the NYSE actually went up, and that's pretty good. And then the NYSE McClellan oscillator and summation indexes are positive. We're getting a mixed picture with the Swindlen Trading Oscillator, Parabolic SCR. The oscillators based on the S&P are flat to weakening still. Ease of movement, money flow, ultimate oscillator, the vortex, financial sector. And then at the bottom, we have this Pring bottom Fisher buy signal, which you can choose to fixate on that or not. I just use it as part of all the various charts that I look at. All right, so our conclusion, no change. If you've watched more than one of these videos over the last few days, a week or so, this is the same conclusion that we've been coming up with. Positive, but not trending. Thank you. Have a really good day on Thursday, and I will talk to you in the next video.